Hi, I'm Jeff Starr, and in this video I'm going to talk about how you can invest money into index funds when you don't have a lot of starting capital. I was inspired to create this video because I have a lot of friends who are musicians and artists, sort of the starving artist type, right? They would often say, if we're talking about things like saving money or investing and stuff like that, that they just don't have the money to do that. And I think that's a fallacy. It doesn't take a lot of money to get started on this journey of making basic investments that can grow over time and become quite valuable. So I personally started doing this, investing in ETFs in particular, years ago. That was one of the best decisions I made. Those investments became incredibly helpful over time and were used for all sorts of things. Purchasing my home, major home repairs, paying off some credit card debt, down payment on a car, and just other major life emergencies that really otherwise would have been very financially disastrous. I'm not trying to sell you a course. I'm not trying to sell you a book or a lecture or a seminar or anything like that. There's none of that stuff. If you're interested in investing and you don't have a lot of money, or you are that starving artist type, you can get into this very quickly and very easily and understand how to approach it. I'm also going to sort of give you an idea of the reality of the amount of money that you can expect to earn over time. And just to that point, initially, like when you start with a small investment, it's going to be a slow growth. Small investments have small growth. Over time, though, small investments slowly grow, and then they're like bigger investments. And now bigger investments, they become even bigger, and then they kind of continue to sort of double over themselves, and there's that sort of compounding interest that you hear about. The nature of the way the stock market works and compounding interest works, that money, if you are continually making small investments into it, it will grow, and it will start doubling over itself over time, and it'll become something that you can feel really happy with. What is an index fund? Index funds are a type of mutual fund that tracks a specific index, such as like the S&P 500, right? The stock market. An ETF is an exchange traded fund, and these would be my personal preference, and I'll sort of explain why as I go through this. When you're investing in a fund, you're investing in a basket of stocks, right? That's a term sort of that gets thrown around. You probably may have heard that before. And instead of buying like, one egg, and is that egg going to turn into a chicken, or is it just going to be a dud egg and it just doesn't ever turn into a chicken? You sort of have a basket with a lot of eggs, and at the end of the day, like you're going to get more chickens than no chickens. The cost to purchase a share of the fund is usually less than a share of a specific company. So if you've always thought about like, I want to invest in Apple or Google or Tesla or whatever those things are that you want to invest in, but the cost of one share seems so high, like I could never invest in that. You don't need to think about that. You can find the appropriate ETF for you, and that's what I would generally suggest looking at. Invest into that, and that would diversify the selection of stocks that you are purchasing, and then you follow and you trade and invest in that ETF as if it is a stock. If you have a 401k through your work, this is maybe a concept you're already somewhat familiar with when you're picking mutual funds for that. In your 401k, you cannot generally pull money out of until you retire. Same with other retirement plans. So investing in something like an ETF or an index fund allows you to have that liquidity to pull your money out as you need it. Just remember that you do have to pay taxes on it once you pull it out, so just always keep that in mind. So why are index and ETFs a good choice for small investors? First, they're relatively inexpensive, typically have low expense ratios, and that's a really key term that you should get familiar with. You pay a fee to own that fund, and a percentage of how much money you have invested into it is what you pay as that fee, and that's what your expense ratio is. So when you're looking at funds, you want that number often to be as low as possible because you want to keep as much of your money and not have it go into paying fees. I'm going to make up sort of a very high outrageous number. If you had to pay 50% of what you had, if you had $100, you're paying $50 out. Well, if your $100 then doubles, now you're paying $100 in fees. And as you see, like as your investment grows, the amount of your fee is growing too. And so you want to get that number as low as possible. When you're talking about mutual funds, index funds, and ETFs, the ETF will often have the lowest expense ratio. Some brokerage houses may actually have a fee that's actually zero, and that's sort of an enticement to get you to sign up and use them as your brokerage house. You have to pay attention to that though, because that may not last forever. They may change that fee over time, so you need to be aware of what those fees are. That's one of the reasons that I like ETFs, is because if for some reason you are seeing that fee changes, you can, of course, very easily sell that ETF just like you would any other stock. You could move it someplace else. And that relates to the second reason why they're good. They're easy to buy and sell. Some brokerage houses might have a minimum investment to open an account with them, but that is generally pretty low these days. If you are opening up, let's say you're opening your account to create an ETF, there may not be that fee. So you always have to obviously read the fine print on who you're looking at. And the third reason that an index fund or an ETF is a really good choice is they have a really long history of success. Morningstar, which is they rate mutual funds and stuff like that. They did a study that showed that over the past 15 years, the average ETF outperformed 75% of actively managed mutual funds. The idea of paying someone else to manage a mutual fund and giving them a huge fee may not be necessary anymore. How to invest in index funds with a small amount of money. One of the most popular ways is to do what is called dollar cost averaging strategy. That rolls right off the tongue, right? You're automatically investing a fixed amount of money into an index fund on some sort of regular basis. So perhaps you do this every month, maybe you do it every paycheck. By making those regular investments, that sort of smooths out the ups and downs and the drastic moves that the market might make. It also actually helps you, it sort of forces you to buy when the shares that ETF have gone down, when the price on it has dropped, or the better way to think of it is when they're on sale or when they're on discount. That helps to actually make your investment bigger faster when it goes down, because you're still putting money in, and then it recovers and you are able to withstand that dip that the market may take because you are thinking of this as a long-term investing strategy. One of the things I would recommend when you are looking for a fund is to pick one that has a dividend. This is something that I always try to do. A dividend, if you don't know, you own part of a company. When you own a share, company's profits are being paid back to you as an owner. Since your fund is a collection of shares of various companies within a certain index that it's following, you get little bits of dividends back from all those companies, and you get that every quarter, and that's sort of like free money. And free money is great money, right? We all, nothing better than free money. One of the things that you can do, and this will depend, I don't know if every fund or every brokerage house offers this, but you can take the dividend that you get and have it automatically reinvested into your fund. If you put in a set dollar amount every month, and then once a quarter, you get that dividend money, and that just automatically gets spent back into the fund. It helps to just give you extra investment into that, and helps to grow it a little bit faster. And I like this too, because when you're starting out, the dividend is probably very small. If you're starting out, if you're making your initial investment with, a handful of dollars or something, then that dividend is going to be really tiny. It's not worth letting those pennies accumulate and to withdraw them and go spend them somewhere. You might as well reinvest them, because it's going to do you more good in the long term, because your goal is to build it up so that it can start to double over on itself and have that compounding interest. So to recap, it's really as simple as the following. 1, decide even the most basic amount that you can afford to invest. Anything is better than nothing. Just really make sure that you're not putting yourself into debt by putting that investment aside. And this is, I think, something that a lot of people say, well, that's why I can't afford to invest, because I just don't have that money. It can be something really tiny to just get this happening and get you excited for it, because I think that you'll start to see oh, this is actually working, and you'll be more motivated to continue to find ways to put money into this investment. 2 is to make sure that you're doing those regular investments, have that money deducted from your paycheck automatically. You want to be able to buy not just when the fund is going up, but when it's coming down and you're getting it on sale and on discount. Number 3 is to look for a fund with that low expense ratio. Now, I'm not going to recommend what fund that is. I think as of, I wrote this down, as of January 2023, there are 3,030 ETFs being traded currently. So that's a lot. Find what you want to track. It's probably something like the S&P 500, and then find one that has the lowest expense ratio you can. Another fee you can look for is how much it costs to buy and sell these shares. Certainly, if it's going to cost you $15 to purchase, shares, then that's going to cut into your profit when you're starting out. So you want to look at that, not only just that low expense ratio, but just also, does it cost you anything to buy those shares? Number 4 is to find out if you can have those dividends, or to first find a fund that has dividends, and to then set those dividends to reinvest into itself so that you can continue to grow the money that way. And number 5, and probably the most important, well, not the most important, but very important, sort of the whole point of this type of investing is to just wait. This is not an overnight thing. You need to think of this in terms of years. Some people might say even decades, but that's really going to depend on your investment strategy. But certainly, I would say years is a good way, or good mental mindset to put yourself in. You're looking to make those regular investments, and you're going to wait, and you're going to let it grow, and don't panic. Give it time. Wait. And once again, think of this as investment as a over years. It's not over days. If you have questions, leave them in the comments. If you think I got something totally wrong or you disagree with this advice, put it there too. Thank you very much.